Coincidence? Maybe. But this exact sequence has happened 4 times now. And each time, the same institutions benefit, and each time, retail traders lose everything. I'm Daniel Brooks, and this is the 4th video in the series on the precious metals crash. The first 3 covered the mechanism, the aftermath, and the structural forces driving the long-term cycle. This video is about something different and something most people fundamentally misunderstand about how modern markets work: leverage. Not in the abstract sense, not as a concept you learn in a finance textbook, but as the actual mechanism that turned what should have been a normal market correction into the largest single-day crash in precious metals history. Because here's what most people don't understand. The crash on Friday was not caused by the Fed chair announcement. The Fed chair announcement was the spark. The crash was caused by the structure of the modern financial system, a structure that is designed, intentionally or not, to produce exactly these kinds of catastrophic liquidation events. And understanding how that structure works, how leverage amplifies moves in both directions, how margin requirements can be weaponized, and how volatility itself becomes a mechanism for wealth transfer, is critical. Not just for understanding what happened last week, but for understanding how the next crash will happen, and the one after that. If you want to understand the mechanics underneath the headlines, subscribe right now. Because what we're about to cover is not something you'll find in mainstream financial coverage, and it matters. First, let's be clear about what actually triggered the crash. Because if you only looked at the price chart without context, you'd assume some fundamental economic crisis had occurred. Gold down 12%. Silver down 35%. The largest single-day decline in history for both metals. But there was no economic crisis. There was a political appointment. Trump announced his nominee for the next Federal Reserve Chair, Kevin Warsh, and the market reacted. Now, here's what you need to understand about why that announcement mattered. In the weeks leading up to it, there was genuine concern, well, not speculation, actual concern based on Trump's public statements and his track record with the Fed, that the next Fed chair would be someone who would completely capitulate to political pressure. Someone who would slash interest rates to near zero, print money aggressively, and allow the Federal Reserve to lose its independence as an institution. That scenario, a politically captured Fed, created what traders call a dollar devaluation trade. If the Fed loses independence, if it becomes an arm of the White House rather than an independent central bank, then the credibility of the dollar as a reserve currency erodes. And when that credibility erodes, investors flee into assets that cannot be devalued by political decisions: gold, silver, hard assets. The Fed chair announcement disrupted that narrative, not because Warsh is hawkish in the traditional sense, not because he's going to tighten monetary policy aggressively, but because he's seen as someone who, while accommodative, will not allow the Fed to become a purely political institution. He has credibility on Wall Street, he has experience, and the market interpreted his nomination as, this is not the worst-case scenario we were pricing in. So the immediate safe haven demand cooled. The rush into precious metals, which had been driven partly by fears of an imminent Fed capture, reversed. The dollar strengthened, and when the dollar strengthens, precious metals, which are priced in dollars, fall. That's the catalyst. That's what lit the match. But a match doesn't cause a forest fire unless the forest is dry. And the precious metals market, by the time that match was lit, was absolutely soaked in leverage. Most people think leverage just makes moves bigger. That's not what happened on Friday. Leverage didn't amplify the crash. Leverage was the crash. And understanding the difference is critical. Here's how leverage works in practice. And I want to walk through this carefully because it's the single most important mechanism for understanding Friday. Imagine you have $10,000 and you want to buy silver. You can do that in 2 ways. Option 1. You buy $10,000 worth of physical silver. You own it outright. If silver drops 10%, you lose $1,000. It hurts, but you're still in the game. You can hold through the volatility. You're not forced to sell. Option 2. You use leverage. You use that $10,000 as margin to control $100,000 worth of silver. That's 10.1 leverage. If silver goes up 10%, you don't make $1,000. You make $10,000. You double your money. But here's the critical part. When you're trading on leverage, you don't get to choose whether to sell. When your account hits the margin threshold, the minimum amount of capital the broker requires you to maintain, the broker liquidates your position automatically. It's called a margin call, and it's not a request. It's forced liquidation. Now, what happens when hundreds or thousands of leveraged traders all get margin called at the same time? They all sell simultaneously. Not because they want to, because they have to. And when they sell, the price drops further, which triggers more margin calls, which forces more selling, which drops the price further, which triggers more margin calls. It's a cascade, a self-reinforcing loop, and once it starts, it doesn't stop until every leveraged position that was vulnerable has been liquidated. That's what happened on Friday. The Fed chair announcement was the initial push, the first 5% or 10% decline. But the cascade from there, the move from a 10% correction to a 35% crash, that was not driven by fundamentals, that was driven by forced liquidation. And here's where it gets genuinely disturbing. Because leverage doesn't just amplify volatility, it creates it. On the way up, when prices are rising, leverage pulls in more buyers. People who wouldn't normally invest in silver at current prices are willing to do so if they can use leverage to magnify their returns. So the price rises faster than it would in a non-leveraged market, and on the way down, leverage forces out sellers. People who would be perfectly happy to hold silver through a correction are forced to sell because their broker liquidates them. So the price falls faster than it would in a non-leveraged market. The result is that markets with high levels of leverage overshoot in both directions, not because of fundamentals, because of the structure, and the people who benefit from that overshooting are not the leveraged traders. They get wiped out. The people who benefit are the entities on the other side of those trades, the entities that can wait out the volatility, the entities that understand exactly when the cascade is going to happen and position accordingly. This is exactly the kind of structural analysis this channel is built around. The mechanics of how leverage creates volatility and how that volatility transfers wealth from retail traders to institutions is foundational to understanding modern markets. If you want more of this, subscribe now. Turn on notifications. Because we're going to keep peeling back these layers, showing you how the game actually works. Drop a comment. Have you ever been margin called? What happened? I want to hear your stories. Now let me show you the pattern that's repeated 4 times. Let me show you something. Because what happened on Friday wasn't new. It wasn't an anomaly. It was the 4th time this exact pattern has played out in precious metals markets. And the pattern is remarkably consistent. 1980. Silver ran from roughly $5 an ounce to $50, a 10x move driven by the Hunt brothers attempting to corner the market. And then the exchange intervened. They implemented new rules. You could sell, but you couldn't buy. Only sell. Think about what that means. A market where you can only sell is not a market. It's a liquidation mechanism. Silver crashed 80%. The Hunt brothers, who had been worth billions, were financially destroyed, and the entities that were short silver, the banks, the institutions, covered their positions at the bottom. 2011. After the financial crisis, investors piled into precious metals as a hedge against currency debasement and institutional failure. Silver ran from $18 to $49, and then the CME raised margin requirements 5 times in 2 weeks, 5 separate margin hikes in 14 days. Leveraged traders were systematically flushed out. Silver crashed 48%, and once again, the institutions that were short covered at the bottom. December 2025. Silver hit all-time highs around $84. The CME raised margin requirements twice during the thinnest trading period of the year, the holiday window when almost no one is actively monitoring positions. Silver crashed 13% overnight. January 2026. Silver at $120. Margin requirements raised aggressively. News timed perfectly. Systems conveniently offline. Silver crashed 35% 4 times. Same mechanism, same outcome, same beneficiaries. And here's the part that most people miss. These are not random events. They are not market failures. They are the market functioning exactly as it was designed to function, because the exchange controls the margin requirements. And the exchange knows in real time exactly how much leverage is in the system and where the breaking points are. They know with mathematical precision what level of margin hike will trigger a cascade. And each time they've raised those requirements, it's been at the exact moment when precious metals prices were at or near all-time highs, when leverage was at its peak, and when the largest number of retail traders were fully exposed. Most people interpret these crashes as market failures, moments when the system broke down. That interpretation is wrong. These are not failures. They are features. The system is working exactly as intended. Here's what I mean by that. The modern financial system is built on leverage, not just in precious metals, in everything: stocks, bonds, real estate, commodities. The amount of leverage in the global financial system right now is higher than it has ever been at any point in history. And leverage serves a specific function. It allows more capital to flow into markets than would otherwise be possible. It allows prices to rise faster. It creates the appearance of wealth and growth. But it also creates vulnerability. And that vulnerability can be exploited. Think about it from the perspective of an institution that's short a rising asset. Every day that asset goes higher, you're losing money. Your short position is bleeding, and at some point, you need to cover. You need to buy back the asset to close your position. But if you try to cover while the price is rising, you push the price even higher, which increases your losses. So what do? You wait for a liquidation event. You wait for a moment when forced selling is already happening, when the price is already falling for reasons unrelated to your position. And then you cover. You buy at the bottom while everyone else is being forced to sell. And if you have enough influence, if you're, say, a major bank with relationships at the exchange, you might even be able to help create that liquidation event by suggesting perhaps that margin requirements should be raised for risk management purposes, for the stability of the market, for the protection of retail investors. I'm not saying that's what happened on Friday. I can't prove intent. What I can show you is the pattern. And the pattern is clear. Every time precious metals have rallied to new highs over the past 45 years, margin requirements have been raised at precisely the moment that would cause maximum damage to leveraged retail traders. And every time that has happened, the institutions that were short have covered at the bottom. Is that a bug? Or is it the design? Now, let's talk about why silver fell so much harder than gold on Friday, because the difference is instructive. Gold fell 12%, silver fell 35%. Same catalyst, same market, dramatically different outcomes. Why? The answer has to do with the dual nature of silver, and understanding that dual nature is critical for anyone thinking about holding the metal. Gold is primarily a monetary asset. It's a store of value, a hedge against currency debasement, insurance against systemic risk. When people buy gold, they're buying it because they don't trust the alternatives, and that demand is relatively stable. Central banks buy gold. Sovereign wealth funds buy gold. Institutional investors allocate to gold as a permanent reserve asset. Silver has that monetary component as well, but it also has a massive industrial component. Silver is used in solar panels, in electric vehicle batteries, in AI data center infrastructure, in military equipment, in medical devices. It's one of the most electrically conductive metals on Earth. And it's essential to a wide range of technologies. That means silver is pulled by two forces simultaneously: monetary demand, the safe haven trade, the inflation hedge, and industrial demand. And those two forces don't always move together. When the economy is strong, industrial demand for silver rises, but monetary demand may fall, because if the economy is strong, people are less worried about currency debasement or systemic risk. When the economy is weak, monetary demand rises, but industrial demand may fall, because if the economy is contracting, manufacturers are producing less and using less silver. The result is that silver is more volatile than gold. It's more sensitive to economic conditions, it's more sensitive to changes in sentiment, and it's more sensitive to leverage. On Friday, when the liquidation cascade hit, silver fell harder than gold because more of silver's recent rally had been driven by leveraged speculation. Gold's rally, by contrast, had been driven more by central bank accumulation and institutional buying, which is stickier, less leveraged, and less vulnerable to forced selling. That doesn't mean silver is a worse asset. In some ways, it's a better one. When both the monetary and industrial forces align, when the economy is growing and people are worried about currency debasement, silver can outperform gold by a significant margin. But it does mean that silver requires a stronger stomach. The volatility is real. The drawdowns are severe. And if you're not prepared for that, you'll get shaken out at exactly the wrong time. Let me step back and offer a framework for thinking about what happened on Friday. Because the standard interpretation that volatility is bad, that crashes are disasters, that stability is the goal, is incomplete, and that incomplete understanding costs people wealth. If this reframe is valuable to you, share this video right now. Send it to anyone trying to understand what happened last week, and drop a comment. Do you see volatility as a threat or as an opportunity? Because your answer to that question will determine your financial future more than almost anything else. Now let me give you the framework. Here's the reframe. Volatility is not a sign that an asset is broken. It's a sign that leverage is present. And leverage creates opportunities for wealth transfer. Think about what happens during a volatility event like Friday. Leveraged traders, retail investors, momentum traders, people who are fully exposed, get wiped out. They lose everything. Years of gains evaporated in a single session, but the metal itself didn't disappear. The gold in the vaults is still there. The silver in the refineries is still there. The fundamental supply-demand dynamics haven't changed. What changed is who owns it. The leveraged traders who bought at the top using borrowed money were forced to sell at the bottom. And the entities on the other side of that trade, the institutions that were short, the whales who had cash available, the central banks accumulating for the long term, bought it at a discount. That's a wealth transfer. Volatility didn't destroy wealth. It moved it. From the people who couldn't withstand the drawdown to the people who could. And here's the critical insight. That wealth transfer is not random. It's not bad luck. It's structural. The people who understand how leverage works, who understand how margin requirements can be weaponized, and who position themselves accordingly, they benefit from volatility. The people who don't understand those things, who trade on leverage, who react emotionally to crashes, they fund the transfer. Most people see volatility and think, this is too risky, I'd rather hold cash. But cash is not stability. Cash is a guaranteed loss of purchasing power over time. Inflation by design erodes the value of currency. Every year you hold cash, you lose roughly 2 to 3% of your purchasing power. More if inflation runs hotter than the official numbers suggest. So the choice is not between a volatile asset and a stable one. The choice is between an asset that moves up and down but trends higher over time, and an asset that declines steadily and predictably. And the people who choose the second option are handing their wealth to the people who own the first. The standard advice is to avoid volatility, to seek stability, to stay in cash or bonds or low-risk assets. And for most people, following that advice guarantees they will never build significant wealth. Because volatility is not the enemy, it's the mechanism. Let me be precise about what I mean. Wealth is not built by avoiding risk. It's built by understanding risk well enough to take it intelligently. And the greatest wealth transfers in history, the moments when ordinary people became wealthy, or when wealthy people became extraordinarily wealthy, have all occurred during periods of high volatility. The 2008 financial crisis. The people who understood what was happening and positioned accordingly made fortunes. The people who panicked and sold at the bottom lost everything. The COVID crash in March 2020. Same story. The people who bought when everyone else was selling saw generational returns over the following 2 years. Friday's precious metals crash is the same pattern on a smaller scale. The people who understand what just happened, that this was a leverage-driven liquidation event, not a fundamental breakdown in the thesis for precious metals, are positioning to buy. The people who don't understand that are swearing off the market forever. And 10 years from now, one of those groups will look back and realize they made a decision that changed the trajectory of their financial life. The other group will still be holding cash, wondering why their purchasing power has evaporated. Now, I want to be very clear about something. I'm not telling you to buy precious metals. I'm not telling you to trade on leverage. I'm not giving you financial advice. What I am telling you is that your relationship with volatility, whether you see it as a threat or as an opportunity, will determine, more than almost any other single factor, whether you build wealth or whether you watch other people build it. So how do you think about what comes next? First, if you hold precious metals, reassess your position size. If you're holding so much that Friday's move caused you genuine emotional distress, If you were checking the price every hour, if you lost sleep, if you considered panic selling, you're holding too much. Position size is the single most important risk management variable. Get it right. Second, understand that more volatility is coming, not less. The amount of leverage in the system is increasing. The geopolitical competition for resources is intensifying. The structural forces driving precious metals higher haven't changed. But the path there is going to be volatile. If you can't handle that, that's a legitimate personal decision. But make it consciously, not reactively. Third, distinguish between leverage-driven moves and fundamental moves. Friday was a leverage cascade. The fundamentals, the supply deficit, the central bank accumulation, the resource war, none of that changed. If you understand that distinction, you can navigate volatility without getting shaken out. Fourth, watch what the institutions do, not what they say. The institutions that covered their short positions at the bottom on Friday are not exiting precious metals. They're repositioning. They're waiting for the next leg up. If you're making decisions based on what financial media is telling you, you're playing a different game than they are. Fifth, your relationship with volatility is a choice. You can see it as a reason to stay in cash and accept guaranteed purchasing power erosion. Or you can see it as the mechanism through which wealth is transferred from people who don't understand the structure to people who do. That choice will shape the next decade of your financial life. The reason this video exists is that most people's relationship with volatility is shaped by fear. They see a crash and they assume the worst. They exit, they stay in cash, and they spend the rest of their lives wondering why they never built wealth. This channel exists to give you an alternative framework, not a guarantee, not a prediction, but a way of understanding how modern markets work at a structural level so that when the next crash happens, and it will happen, you're not reacting emotionally. You're thinking clearly. If this was useful, if it gave you a clearer picture of how leverage creates volatility and how volatility creates wealth transfer, share it. Put it in front of anyone you know who's trying to understand what happened last week, because the standard narrative is incomplete, and the people who only hear the standard narrative will make decisions based on incomplete information. Subscribe if you haven't already. This is what we do here. No hype, no predictions, no sponsored products. Just a clear-eyed look at how wealth moves in the world and what that means for the people trying to build it. The next crash is coming. The people who understand the structure will be ready. The people who don't will be caught off guard. Again, stay informed. I'm Daniel Brooks, and I'll see you in the next one. Disclaimer. This content is for educational and informational purposes only. The analysis and research are human-driven, but markets are unpredictable, and past performance is not indicative of future results. Any investment involves risk. Do your own research, DYOR, before making financial or trading decisions. The creator is not providing personalized financial advice.